getting very close to a potential big pullback in gold. So using Fibonacci, which is one of my favorite tools for getting an idea of where the market is headed, we had this initial sell-off early this year. Then we had this bounce. And you can carry that forward a little bit to see where the downside targets are. So we had the sell-off, and then we had the bounce, and then you hit the 618, and then you have your 100% target. And so we hit that level. And so that move is now done. And so now we have to reset and figure out, okay, well, where is the next chart pattern? Where's the next set of waves? Well, the next wave is this sell-off here, and then we had this bounce. And we'll just carry that forward in future here. And it shows where price should go. We should technically see gold come down to the 618, have some type of pause or bounce, and then come down to the 100% measured move, which is $3,600 for gold. And that'll cause pretty big panic in the market. I think a lot of people in the precious metal space are looking at it as a bullish chart pattern. Anybody who's long metals zooms out and they say, look at this giant bull flag. The next stop is going to be about, 8,000, 8,500 for gold. And that's what it could potentially do. If gold was to turn around here and start to take off, it's heading up to about 8,000 and change. But the pattern on chart right now is actually pointing to 3,600. And so this to me is going to be an amazing opportunity. I think if it comes down here, this is going to reset the price. So if we were to just draw this line all the way across here, you'll notice down here, this was before gold and silver went into this parabolic move. So really if price comes down here, everybody who chased gold and silver up into the beginning of the year, the euphoric phases when volume really took off, the market has a great way of putting pain on those who made quick, easy money, who chased price on emotion. And so all of those who piled in here are going to have to go through the roller coaster ride, the stock market roller coaster, and probably get shaken out and give up on it, right? And this is where we want to get in. The market has a great way of resetting and coming back to a key level. And then from there could provide a really great opportunity going forward. And then I think we see gold take off for many, many years. So if gold drops down to 3,600, it is going to be a very significant support level. As a long-term investor, this is where you could buy physical metals, park them, put them in storage, and probably wait a long time. I think there's a lot of upside potential from there. But when we saw this, I mean, we got out of gold right up into this level. When it hit all of our key Fibonacci targets, and I said, listen, this is the blow-off euphoric phase. We need to, lock in the gains. We'll be able to reload at a much lower price and then rinse and repeat for the next cycle. So that's what we're doing. We literally exited right near the peak, and now we are just letting the technicals unwind, the sentiment unwind, and it just takes time. It could be a short. I'm not a big fan of shorting gold. I'd rather just let it drift and fall and just know that the part I'm excited about is picking it up at a much lower price. But there's no doubt it could be a shorting trade. It is big enough to do that. It's about an 18% drop from where we are. So that's pretty substantial. It has crossed my mind because it's a very clean looking pattern that's forming and there's a lot of downside. But I generally don't bet against gold. I would rather just let it drift and fade down and reaccumulate it later. I think it's about a 50-50 coin toss at this point, which is why we're standing on the sidelines. We're just waiting to see if it starts to turn higher and starts to make some higher highs, higher lows on the short-term chart. We can get back in and we can ride it up for the next target. If it drops, we're just going to let the value come back down and we'll be able to pick it up at fair value or below fair value and get a good deal on it. So again, one of my core beliefs is not wasting time with our capital and not having extra risk and stress when you don't need to. Gold had all the signs and silver of a peak, and we have locked in those, and now we're just letting it do its thing, because for all we know, we actually could see gold and silver move lower, build a base, start to rally, and it could be 3 years from now. And 3 years, I'd rather take all that money and reinvest it in the stock market. I'd rather actively invest it into something else that's making me money for 3 years and then move into gold when it's ready to scream higher for many years, right? So I don't like to have dormant money stuck in a commodity. Gold gold is an expense. I mean, I used to see my monthly statements for storage. I'm like, oh my gosh, this is, especially as the price of gold and silver skyrocketed, the last storage bill was huge. I was like, this is ridiculous. Gold costs money to hold. And if it's going sideways for 2, 3, 5, 10 years, that is a huge expense. You'd be better to dump it somewhere else. So even in cash, you'd make money, right? So gold is an expense to carry. And so it better be working or I don't want to hold it. That's the way I see it.
30 to 1 if we get anywhere near there. I think that means that silver is in the triple digits, 100, 200, 300. I don't even remember what it was. I don't remember the math, but it's a lot higher than it is now. So really, nothing is actually happening in silver. And I'll prove that to you with the ETFs and the physical markets. I just had an interview with Brian Kuzmar of Commercial Rare Coins and Precious Metals, who said that the spreads in physical markets are wide apart, which means there is almost no activity in the coin market. The stackers have not woken up. Those that have already stacked have already stacked. They're all stacked in. And the new people aren't joining yet. Maybe a little bit of a trickle, but nothing big. So no ETF demand, no physical demand. Silver is only running on one of 3 cylinders. And the only cylinder that's running is the big whales, or those that are stacking silver in New York. That's because the silver supplies in New York on COMEX keep climbing and they do not stop. And the only way that silver supplies are going down in the ETF, 17 million ounces have been drained from SLV over the past 3 days. The only way that happens is if some whales are taking silver out of the ETF because of lack of demand from retail that don't want to buy the ETF because they're not really paying attention. And why aren't they paying attention? Because the AI bubble and all the other bubbles are still kind of bubbly, and they still look at their portfolios and they say, wow, I can buy so much with all these amount of dollars in my portfolios. But once the silver to S&P 500 ratio starts to climb or fall, if you have it the other way, basically, once the Dow and the S&P get cheaper in terms of silver noticeably, then you'll start to see people panic out of mainstream stocks and bubble stocks and go into gold and silver. That hasn't even started yet. We have a long way to go. U.S. real estate. I wanted to go into this in terms of gold because we broke a low here in terms of how many ounces of gold it takes to buy a single house. We broke below 120 ounces. I think that is the low here in 2011. This is September 2011 when gold hit a bull market top over here and then had a bear market over here. But now that is done. We hit like a triple, quadruple, whatever top here. Couldn't get through that resistance. And now we are below 120 ounces of gold per house. I expect this to go down to the 1980 level of that looks to be around 70. It's going to get lower than that in Weimar. Remember, it took about $100 bill to buy a swanky house in Berlin. That's about 5 ounces of gold. I expect that we will go there for a time. It will not be sustainable and it will not be sustained, but for a time, you will be able to buy a nice sized house for about 5, 6, 7 ounces of silver. Exactly what it will be. It won't matter because the stackers will have a much more than that, and it won't even make a difference. What about silver? Well, that we haven't hit we haven't broken through the trend line yet, and we haven't hit resistance yet at about just below 5,000 ounces. Maybe that's 4,900, 4,800, something like that. But here is the trend line from 1980. We can see here we were about, what is that? Maybe 1,700 ounces, maybe 1,500 ounces in 1980. I don't know exactly what it is, but we have to break through 10,000 and get through this trend line, but we will. And we'll see this number fall faster than it will in gold. And we should break below the 1980 line here. If we do get to the Weimar area, then you should be able to buy a decent house for about 75 to 100 ounces of silver for a short period of time. At that time, you don't want to necessarily find the best deal. You just buy whatever is available because everybody needs silver, because there's no other way to divide labor, because credit doesn't work, which is why prices in silver will be so low at that time, because of the desperation for real money with which to divide labor will be in desperation levels. UK real estate, just wanted to look at that. These are all from Gold Charts or Us. UK real estate is pushing 100 ounces of gold for a house. This is the average in all UK property price. I don't know how exactly accurate these are. These are estimations, but you can see here the trend is obvious. We're going to break through 100 ounces in the UK. One more chart, UK housing in silver. You can see we broke through 10,000 ounces. We're at 9,722. And we have a trend line. I didn't actually draw it here. I think we're right on that line from 1980. If you draw a trend line here, touching the 2011 high, and then touching here. I think we're right on that trend line, but it doesn't really matter. These things aren't exact. I also wanted to go into China. Real estate. Since we're talking about real estate, let's talk about China real estate. I haven't really covered this, but Phil Lowe of the Bitter Draft alerted me to this guy in China who was talking about Chinese real estate. It's really bad.
He's very.
If you look at this is China property investment year over year. I don't know what the units are. I'm just looking at the trend here. You can see here China property investment has been falling net since 2022, and it keeps getting worse and worse and worse. There is a real estate bust going on in China, which is very serious. And you have an entire country that is forcing everyone to put their savings in real estate. Ghost towns of crappily built housing that even made in China. When you see made in China on a tag, it doesn't seem good. So, but they're in China and it's made in China because it's real estate in China. It's really bad stuff. This whole thing, China's screwed. Forget it. They're gone. At some point, there's going to be a repo crunch. I don't understand how you can have more repos trading every night than dollars that exist in the banking system as we break through a 45-year resistance and we find a new level for silver that will be closer to the 30-to-1 ratio that we hit in 2011. I don't know how long it's going to take, but silver's headed to the triple digits.